Okay, so you might have heard of everyone going a little bit crazy about Joe Biden's tax policy that's going to happen and taxes for the rich, and then you have both sides going at it in a battle. What is right? What is wrong? Are these tax raises for everybody or taxes just for the rich? Stay tuned and we'll talk all about Joe Biden's tax plan and how it might impact you. How's it going? My name is Eric, and as always, I am here to help you find freedom and abundance. And so I've been getting this question a lot with regards to all the new proposals coming out with regards to Joe Biden and the new tax proposals that he's been putting out there. And you see a lot of apocalyptic predictions. Oh, this is the end of America and there's taxes going crazy. And then you have the other side saying we need to increase taxes to accommodate the spending that we've had. So which one makes the most sense? Now, I want to give you a little bit of context and background. I've been a tax advisor for over 12 years now, and I've seen tax code change administration to administration. And I want to tell you one thing when it comes to tax code is tax code and the income tax is a moving target. Basically meaning that it can change from year to year, administration to administration, depending on what the political willpower is. So even if there's something that does get locked in this administration that might not be overall beneficial for the general economy, guaranteed that it's going to change in the next administration. Just like in the previous administration, the Trump administration, he had a lot of tax cuts for the wealthy and corporations. A lot of them pushing the tax rates lower than they've ever historically been. And so in turn and instead, what's happening now, we're going to be having a rise to it. So let's take a look at what some of these proposals look like. So this is just from CNBC. Biden wants to raise $1.5 trillion by taxing the rich, right? And these are like big trigger words: tax the rich, eat the rich, right? But what does it really mean outside of this political, emotional, like rabble rousing? So let's break it down. And this is from what they call the American Families Plan, and he unveiled it on Wednesday. The proposal seeks to raise $1.5 trillion over a decade via higher taxes to the top 1%. And it's going to increase capital gains and ordinary income and increase audits for those earning more than $400,000 per year. So basically what that means is for the vast majority of Americans, your tax rates, your tax liability, what you owe to the IRS every year, should not change or not change dramatically because the vast majority of Americans are making under $200,000 per year as married filing joint as a couple. So this is not going to affect the vast majority of folks. But for those that are successful, either as entrepreneurs, executives, I fall within these categories as well, it does raise a little bit of concern. Does this mean I have to pay more to the federal government? And if I paid more to the federal government, am I getting more services in return? And what does that look like? So let's break this down a little bit more. The most common question that a lot of folks are talking about is when it comes down to it, first of all, the richest 1% of taxpayers have an average income of 2.2 million, and I don't believe that's actually the case. I believe like the actual richest 1% of taxpayers make quite a bit less than that. So there is a little bit of a challenge inside the data here. So 2/3 of the group will see their taxes increase by about $159,000 per year if they're making over $2.2 million. Sounds like a lot. So here's a couple of things. First of all, Biden's plan would raise the top income tax rate to 39.6%. Now that's the rate it was prior to Trump coming into office. Prior to Trump being in office, when Obama was in the president's seat, it was 39.6% was the top rate. When Trump came into office, he reduced it to 37%. So what does that mean? Is this a massive tax increase? No, not really. We're just reverting to the tax code that was prior to Donald Trump in office. So is this really tax hike? I don't really think it is. Households with more than roughly $540,000 of income fall amongst the wealthiest 1% of taxpayers. That's more of the number I was thinking about there. And this precise income threshold for which this rate will kick in is for, if you're single or married is unclear. They haven't really come up with the exact tax brackets. Now, what does this mean? Does this mean like every dollar you make, if you make $500,000, does that mean now that you have to pay, let's call it 40% to the federal government on the $500,000? No, that is not what that means. Tax brackets tax you on graduating increases of income. So for example, let's just pull up how tax brackets works just so that we're on the same page here. Tax brackets. So if we were to look at the tax brackets right here, super simple, straightforward. If you're, the first $10,000 of income you're making as a single person is at 10%. The income they make from 9 to 40,000 is at 12%. 40,000 to 85,000 is 22%. And if you're making over $518,000, that's when you get taxed at the top rate. So that means that if you're making $500,000 a year, not all of your money is being taxed at 40%. Actually, in this particular situation, if you're making $500,000 per year, the top bracket from $207,000 of income to 518 is being taxed at 35%. So just want to clarify that. So when it comes to it, the tax rate will go up. And then the biggest thing that I hear a lot of folks are talking about is the doubling of the capital gains tax rate. Now, what are capital gains? So if you're working for somebody, you're at 9 to 5, you're punching a card in, you are getting what we call earned income. Earned income is what you receive on a W-2, or if you're a small business owner you'll get a K-1 or a profit share distribution from your company. That's taxed at ordinary income. Now, capital gains is tax on your profit when you invest in the stock market or real estate or cryptocurrency. Meaning, let's say if you put $10,000 in Bitcoin and Bitcoin goes up by 100%, you double your money, now you're at 20 grand, you're paying tax on the 10,000 of gain, not the entire amount. Now, if you held on to your Bitcoin for less than a year, your tax on the Bitcoin is on the profit and it's taxed at your ordinary income tax rate. So again, if you are in a income range of, let's say you're making $100,000 per year, that tax on your Bitcoin profit will be 24%, meaning you would have to pay $2,400 on tax on $10,000 in profit. Now, if you had a long-term capital gain, meaning you held that Bitcoin for longer than a year, you'd be paying less in tax. I don't have this spreadsheet up here, but based on this income, it's probably going to be about 10%. So on $10,000 of gain of Bitcoin, you would now pay $1,000 of long-term capital gain tax. That's normal. So what is changing? In Biden's proposal, they're proposing to change the long-term capital gain instead of that reduced amount. They are proposing to tax it as if it is any other gain, whether it's short-term or tax at ordinary income. So if you made that $10,000 in Bitcoin and you're being taxed at a rate of, again, that 24%, instead of getting a little bit of a discount for holding on to it longer, now, even if you held on to it longer, you're still going to be taxed at 24%. But however, here's the caveat. This only applies for taxpayers who are making at least $1 million per year. So if you are a person making $75,000 a year, and let's say you did well in the stock market, you made another $100,000 there, you have a total adjusted gross income of $175,000. You don't meet this threshold, you're taxed as normal, all good to go. Now, if you're a taxpayer that's making, let's say you have a business where you're earning $800,000 per year, and I know a lot of us would love to earn that, but the vast majority of Americans do not, so a lot of folks are not going to be snagged by this. So if you're making $800 grand per year in your business, and let's say, for example, in the stock market, you did really well, and you broke $300,000 per year, which now pushes you to $1.1 million of income, then this increased capital gain tax will ensnare you. Right? So who is this really going to affect? It's going to affect folks that either are cryptocurrency millionaires overnight, where now they need to cash out their gains. They made $1 million investing in Link when it was super cheap, or Dogecoin, or Elongate, or whatever crazy coin that you're investing in. You made $1 million and you sell it that year. Actually, it's not really going to change anything because it's still a short-term capital gain, still taxed at ordinary income tax rates. This, again, only applies for long-term capital gains, things they held on for longer than a year. So I don't think any crypto guys and gals are going to be snared by this, right? So who is it going to be snared by that could be what we would consider middle class? Let's say, for example, I was running a business, and I am, and I decided to sell my business, and then the person that wanted to buy my business wanted to purchase it for $1.5 million, which would be freaking awesome. That at that one point, my income would spike to a point where it's above $1 million, and now the capital gains that are built up within my company are going to be taxed at a higher rate, right? So that's who it would ensnare if you're a middle class person. So the question is, gosh, Eric, you're probably sitting there saying, gosh, Eric, how do I if I was in that position, how do I avoid paying this higher tax rate? Because at the end of the day, like I said, the tax code is a constantly moving piece. So the thing is to, instead of being angry and instead of like yelling from the rooftops how bad you hate politicians, instead you want to properly plan how to get around these things. So if you were to sell your business at $1.5 million, which would push you in this capital gain threshold area, instead you could set up the sale of your business through what we call an installment arrangement or installment plan, where now you would be paid half your business this year and another half next year, so your income never hits that threshold, right? Or you could use a lot of or a myriad of other planning tools to be able to do that. There's options. Just want to let you know there are options. And a lot of folks aren't talking about that because the people in the news, the people in politics, the reality, my friend, is they just want to make you angry and they just want to make you feel stressed out because it's going to force you to watch more politics and force you to watch more news. And it's a self-perpetuating cycle where they just want to suck you in the system of anger and fear and scarcity. And I want to have no part of it, and I hope that you want to have no part of it as well. So this opens up this conversation of, gosh, okay, if the tax code is changing, number one, will it affect me? Will it impact me? And number two, if it is going to impact me, how do I plan around it? And you could obviously see there's a couple things that you can do. So that's probably the biggest thing that a lot of people are talking about. They're also changing how they do estate taxes upon death. They're looking to remove what they call the step-up in basis. Step-up in basis, it sounds funny, right? It's like you're stepping up a stair step. So think of it that way, right? You're stepping up the stair step. Meaning, let's say if Grandpa purchased a home for $100,000, he left it in his estate, and then he ended up kicking the bucket. And now when he kicked the bucket, it's worth $500,000. And then it gets heired to the kids that inherit it, or to dad or mom or whatever. They normally would get a step-up in basis, meaning Grandpa bought it $100,000. When he died, it was worth $500,000. When you inherit it, your basis, which your cost is $500,000. So if you sold it at that point for $550,000, you'd only have technically a $50,000 profit, right? Even though you got the house for free. So what they're looking to do is take away what they call the step-up in basis. So if Grandpa bought the house for $100,000, he died and it's worth $500,000, and then now you inherited it and you sold the home for $550,000, your basis would be Grandpa's original basis, the $100,000 that he paid for it. So meaning you would have a profit of $450,000, right? So that is a dramatic change. That is a dramatic increase in things. So what a lot of folks do, and what you might want to consider doing if that is a scenario, we're going to see a lot of people start using trusts and irrevocable trust and revocable trust, all these different types of tools to be able to get around that whole step up in basis concern. Or they might even, when they sell it, it would be a long-term capital gain. Instead, at that point, they would roll it over into another planning tool, like a opportunity zone fund. So when it comes to capital gains, they're looking at taking away that ability to reduce or mitigate the tax on the growth of the property while the person owned it before they passed away. And that's really about it. Now, is it going to impact folks? Possibly, right? Because a lot of folks, the biggest nest egg that most folks accumulate is the value of their home. And if you pass away and you pass on your home to your kids or whatever, that appreciation would have normally come to them on a tax-free basis. Is that fair? Is it not fair? That's not for me to say, but that just means now that there are planning considerations where you might want to consider getting a life insurance policy to cover that capital gain estate tax. Or you might want to do some planning with your estate planning attorney on putting that property into a trust or into something like a opportunity zone fund where you could avoid and reduce the capital gains long term. Right? So there, again, I want to just throw this idea out at you that when tax code changes, it's not a negative or positive thing. It's more of a planning opportunity. How do we plan around this? How do we mitigate this so that way we don't have to live a life of fear and scarcity and just being caught up with the hype of the news? So the next thing that they're looking to take out here, and I don't know if it's in this here, is, or they're looking to audit more taxpayers. Now, what a lot of folks don't realize, and I've been in the tax space for over 12 years, I represent taxpayers at audit, all that kind of stuff. Typically, the clients that are going into audit are folks that are making lower income. The computerized audits are usually sent to folks that are making under 100,000 per year, and the desk audits are typically sent to folks, at least in my experience, folks that are making anywhere below $300,000 per year, right? However, the wealthy, by and large, folks are making over $500,000 a year plus, their percentage of audit and their rates of audit are dramatically lower than those of lower income. Why is that? Why does it sound like it's an unfair system? It's because the IRS knows that if they were to audit somebody of lower income, because of the fear associated with the IRS, most of those folks will find ways to come into compliance or just fess up or just pay the bill and not make any noise about it. Whereas folks who are wealthier, they typically have attorneys and accountants that will stretch this thing out, and the IRS might never calculate or actually collect the money upon it. But it's an unfair tax regime system. And a lot of folks are realizing that. What a lot of folks don't realize is some of the wealthiest Americans that are making over $100 million per year in income are the ones that are providing or creating some of the craziest tax evasion things out there, and the IRS really hasn't been pursuing it. There's trillions of dollars built up in tax evasion done by folks that are in that $100 million plus in income. So Joe Biden is looking to allocate more resources to the IRS to allow them to audit more of the folks that are in the wealthiest side of the Americans, right? Is this a fair thing? At the end of the day, this is tax code. This is compliance. It's not a thing of fair or unfair. If anything, it is more fair to those of lower income because now wealthy folks have the same chance or similar chance of being audited as a lower income person, right? So I don't foresee any type of struggle with that. The last change that is happening with the Joe Biden tax code is the reduction or the potential elimination of what they call the 1031 exchange. And I wanted to just clear this one up. 1031 exchange, Biden. Let's look this one up here. So a 1031 exchange is usually used for real estate investors. This is not for your primary residence. This is not for your vacation home. This is typically for people who are landlords or they have commercial properties or warehouses and stuff like that. Where basically, they purchased a piece of property, it appreciated in value, they sold it, and now instead of putting the money in their pocket where they're paying the tax, they're just reallocating that to the next investment property. And by doing that, all they're doing is they're shifting their long-term capital gain tax to another point in the future. It's a tax deferral tool. So again, it normally doesn't apply for folks that are homeowners or, that are, living in a condo or something like that. This is typically folks that have a real estate portfolio. Now, they say that this is a $41 billion tax break, and I don't necessarily agree with this on the fact that they want to take away the 1031 exchange. The way it works, again, is they're looking to take away this ability of deferring capital gain tax on gains of over $500,000. So they are trying to target, again, higher income, higher wealth type of individuals. California is a bit of a bizarre thing because the houses here, I live in a 3-bedroom condo in California and I love it. Southern California, it's great. But this is like a $750,000 property, $750,000. Whereas if I was still living in Massachusetts, the same home that I'm living in will probably go for $150,000. $150,000. So to hit that $500,000 of capital gain is not really difficult. So that is a potential ensnaring challenge, right? And on top of that too, by taking away the 1031 exchange, it's going to decrease liquidity in the market because people are going to be concerned about paying tax. If they can't roll that into the next investment, it disincentivizes them from wanting to buy and sell and trade and move up in properties. So that's why I don't necessarily agree with the reduction of the 1031 exchange. I see where they're coming with it. I do see the fact that they're looking to change that 1031 exchange for gains of over $500,000. So I get that, but also understand that tax code is also designed to fundamentally change the way people do certain habits and do certain things, like that long-term capital gain tax rate, right, that we talked about earlier. If you have a lower tax rate for holding on to stock longer, what you're going to end up doing is you're going to hold on to that stock longer. And when you hold on to a stock for a longer period of time, that stabilizes the market and makes it less speculative because people have to be in it for longer to get the tax benefit. Now, if you take away the long-term capital gain tax rate and lump it in with all other income, that makes the market more volatile because people are more apt to speculate. They have no longer an incentive to hold on to stock for a longer period of time. So I just want to let you like some insight into why tax code works and how it works. Tax code is designed to make, not necessarily force people, but condition people to do certain things. Get married, you get a tax deduction, right? If you go to school, you get a tax break or a tax credit. If you purchase a car for your business, you get a tax break or a tax credit for that. If you invest in stock, at least for now, for a longer period of time than a shorter period of time, you get a tax bonus for it. If you start a business, big tax break. You invest in your health insurance, your medical care, donations, tax break, right? So tax code is designed to fundamentally incentivize folks to make certain habits and certain changes. And I don't know if they fully thought some of this through, but that's what I wanted to break down on the Biden era tax code, tax increases, and let you know. And hopefully this reduces a little bit of anxiety and a little bit of stress. If you're making under $1 million per year, you're probably not going to have to worry about any of this. If you have stocks and bonds in your investments on an annual basis, you're making less than $1 million, and I get it. A lot of folks are like, I want to make $1 million. I do too. But the reality is most folks do not. 99% of folks do not. 99.1. If you're making less than $1 million in capital gains, this is not going to ensnare you. If you're not actively buying, holding, selling real estate property that's over $1 million, this is not going to affect you. By and large, the vast majority of these tax changes are going to affect folks in the wealthier income range. And for those that it will affect, there are a lot of planning tools and considerations that you can use to alleviate yourself from the stress and anxiety of thinking about this tax. So I just want to leave that out there. And I just want to close this out and just let you know that at the end of the day, historically, tax rates at its highest was anywhere between 77 to 90% at the highest tax bracket. Right now, our highest tax bracket in America is 37.1%. We have a gulf of almost 30% between when we had the highest tax rates and where we are now. 60% difference. Did I say 60%? 60%. At the same time, too, our government debt and deficit are the highest rates that they have ever been. Like, we have trillions. Like, I don't even know how to fathom the zeros or the stacks of money that make up $1 trillion. We have trillions of dollars of debt and a massive deficit. So we've been collecting very little money for a long time, and we've been spending a ton of money for a long time. So we've been living in this like afterglow of basically working retail Target, but spending money as if you're CEO of Microsoft, right? At some point, things have to change. We have to increase tax revenue, and we have to decrease spending. So hopefully, with this increase of tax revenue that's coming with this, we will also see the government looking to reduce spending. And if that's the case, I think we'll have a beautiful thing. But as we all unfortunately know, because of the complexity of the government, reducing the size of the government probably isn't going to happen. Anyway, my name is Eric. I would love to hear your thoughts. Do you think this Biden tax era change is going to be impactful for you or not? Pop them in the comment section below. I pop up videos here once a week. I would love to hear from you. Pop them in the comment sections. I respond to each and every comment. If you're new here, hit the subscribe button. Say, yo, what up? Click on the bell so that way you're notified. And with that said, I'll see you again soon. Here's to your wealth, prosperity, freedom, and happiness. My name's Eric. Take care. Peace.